Hey guys, and welcome back to another video. In today's video, we are going to be doing a little head-to-head comparison of US Treasuries, something that we cover a whole lot on this channel, and government agency bonds, something that we've just sort of been getting into, but they have a whole lot of potential. To start off our comparison, I'll lead with the number one reason that I think you should be considering these government agency bonds, and that is quite simply that they pay a higher rate than US Treasuries. You can see particularly in the higher ranges when it comes to time period, they pay significantly more. This one tops out at 6.15%, while this one is down around 4.7%. That is a significant difference. Now you might wonder why I skipped straight to the 20-year bonds when for some of you, including for myself, I would rather sit in these lower time periods of maybe 6 months to 2 years. But the thing is with these government agency bonds, even if you buy a 20-year duration, I can almost guarantee you that it will not actually last for 20 years. So let me explain exactly why. The reason why these 20-year agency bonds at this point in time at least will almost 0% chance actually make it to their duration is the fact that they're callable. Now, what exactly does it mean to be callable? You can see right here, it simply means that the issuing agency can decide to pay off the bond early, and at that point, you'll obviously stop receiving the interest payments. Now, this obviously is going to be pretty different from something like Treasury Direct, where you buy your T-bills. You can see very clearly the auction date, which is, of course, your date when your interest rate is determined, and the issue date. And with, for example, a 2-year Treasury note, that is going to be expiring exactly 2 years from that issue date. You know that for a fact, so you know exactly when you're going to get your money back. You might have also caught at the top of that last paragraph that we had a look at the fact that these bonds tend to be called as interest rates from the federal government begin to decline. Now you can see that ever since interest rates began to increase near the beginning of 2022, they sort of leveled off at the end of 2023, and they now sit fairly steady just over 5%. Now we already do a whole lot of videos on current inflation and interest rates and the bond market in general, so I won't get into that, but eventually this interest rate will likely go down. As we can see from previous trends, sometimes it stays a little higher than other times, but eventually this interest rate will go back down and these bonds will likely be called. That's why towards the beginning of this video, I pretty much promised you that even if you buy a 20 or a 30-year agency bond, it's not actually going to go to maturity. You're going to get your money back a lot sooner than that. So now the question becomes, when exactly will you get your money back? In my opinion, this is one of the biggest cons to agency bonds at this time, is the fact that there is a whole lot of uncertainty about when you'll actually receive back your principal. Now, another difference with these agency bonds compared to Treasury bills, bonds, and notes is the fact that you can't buy them on Treasury Direct. Instead, you'll have to go to the secondary market via something like a brokerage. The one that I use is Charles Schwab, so let's go ahead and have a look, and we'll find out exactly when these bonds can be called, and that will give us a little bit of a sneak peek into when we might get our money back. Now, when they can be called depends on the bond. Let's click on this first one that has a yield of over 6% and check out when it can be called. When we do that, it'll pop up this screen right here. It says that it's callable beginning May 16th of 2024 with at least 5 days of notice, and it's callable every month. Now, the fact that I'm recording this video on May 27th and it's still purchasable means that it was not called on May 16th, but you can see from this very long list, once again, it's callable monthly, anytime going all the way to 2044. Once again, I can guarantee you it's not going to make it that far, but there's a whole bunch of uncertainty as to which month this agency issuer will actually call it. Having a look at this different agency bond that's paying just under 6%, you can see that this one is not callable until the end of August. However, a little bit of a difference is the fact that it's callable daily beginning after August. The call schedule doesn't even pop up because there's so many options. This one basically can be called at any time beginning at the end of August. I think y'all sort of get the idea of these agency bonds, higher interest rates, but a whole bunch more uncertainty as to when exactly you're going to get your money back and for how long you'll be getting paid that interest rate. Let's have a look at some of the more finite details of agency bonds compared to treasury bills, bonds, and notes. The first thing that we're going to look at is taxes. Now this right here is talking about agency bonds. We didn't mention it. I did cover it a little bit more thoroughly on my What is Agency Bonds video. I'll pop that up in the top right corner of your screen right now. But there are different types of agency bonds. Some of them are state and local tax exempt, and some of them are not. The ones that are going to be exempt from those taxes are the Federal Home Loans Bank and the Federal Farm Credit Bureau Bank. I don't know what TVA stands for, but apparently that one is also exempt from taxes. When we compare that to treasuries, you can see that the IRS will tell us that interest gained from treasury bills, bonds, and notes is exempt from all state and local income taxes. The last thing that we're going to talk about is how guaranteed, how backed are these bonds that you're buying. We know that treasuries are fully backed by the US government. When you invest in them, you are guaranteed to get your money back. There's no default risk. This is also the same with federal government agency bonds. Again, this goes into the difference between types of agency bonds, but to keep it short, the federal government agency bonds are fully backed and secured by the US government versus the government-sponsored enterprise bonds. These are still considered agency bonds, but they're a little bit different, and they are technically not backed by the federal government. I say this, however, keeping in mind that these agency bonds are still rated at AAA, which is the lowest level of credit risk. Your actual chances of experiencing a default of the bond in which you lose all of your principal that you put in is extremely low. I hope you did go on to enjoy today's video. You can see that depending on what you have in mind, what your investing goals are, agency bonds could be better for some and treasuries could be better for others. If you have any questions or comments, throw them down there in the comment section down below. Leave a like on the video and subscribe so you don't miss any more videos like this one. But other than that, we'll see you in the next one.